Seven Rules of Wealth number 3, Long-Term Care End Run by William Baldwin on Forbes. Wow, this reads like I had written it. So kudos to my man William Baldwin. I just did a video on his where he talks about the mortgage mistake. Yeah, I kind of agree with that. I absolutely agree with that if you're going to be using mortgage and you're simultaneously having bonds in your portfolio. Don't do that. But his reasoning was that mortgages or the home appreciation has been through the roof, in your parents' time is not that anymore. And that's not true. Actually, I'm sure there are certain areas of Portsmouth, New Hampshire, Greenville, North Carolina, whatnot, that is South Carolina, whatnot, that is true. But the vast majority of the country just did not have the extraordinary growth that a lot of these guys say it did. It just did not. You can look at Zillow, you can look at the Census Bureau. Anyway, but this is interesting. By the way, I agree with William about his take on mortgages. I 100% agree. If you're going to have a mortgage, well, hell's bells, man, get rid of your stupid bonds. It doesn't make sense. I agree with that 100%. All right. This is spot on. I don't know if this guy watches the channel. I don't have any idea, but I could not have said this better myself. So let's read what he says. Experts say you should insure against the cost of a nursing home. Experts, at any rate, who work for insurance companies. Right on, William. I have a different notion on how to deal with this cost. The idea that with a long-term care policy is that you start when you're healthy and young, like my wife and I did when we were in our 30s, and pay a fixed premium for many years. Keep up the payments, and the insurer can't kick you out if your health deteriorates. When you go into a home, the policy will cover a certain amount of cost, like $300 a day for up to 3 years. In effect, you're building equity for a few decades and cashing in for a short time. But there's a catch. The insurer has the right to raise the premium down the road. A lot of them have done just that, sometimes by savage amounts. Then you have a choice. You can pay the higher premium rate, or you can keep your benefit. Or you can keep the premium where it is and cut your coverage. Or you can drop it all, losing all the money you put in. Can you imagine buying a house this way? You borrow $210,000 at 4% and promise to pay $1,000 a month for 30 years. 15 years in, the bank announces it's raising your mortgage to $1,800 a month. If you complain, you're informed you can keep the payment at $1,000 a month, but you got to move to a smaller house. That's ridiculous to write a mortgage contract like this. It would be ridiculous in a whole life policy, and I think it's ridiculous in nursing home insurance. Well, nursing home insurance and whole life policy is a little bit different. The different risks they're insuring. Premium hikes are just one of the hazards with long-term care policies. The other is that if the insurer gets into a bind, which it will if it underestimates how much the cost will be, i.e. how long people live, it will fight your claims. Your relatives, not you, because you're out of it, may have to hire doctors and lawyers to get the money. Insurance is supposed to let you sleep well. This kind of insurance would keep me up at night, though. People of limited means shouldn't put money into long-term care policies. They can reasonably expect that Medicaid will cover their stay, as long as people don't use Medicaid if they have money. I tell you, this is my pet peeve. If you got money, you should not rely on the government to use Medicaid, because you're taking money from someone who truly needs it. If you've been blessed with abundance, you should pay your bill, your fair share, and if you run out, then you can turn on Medicaid. I take extreme issue with this whole thing about Medicaid planning. I don't like that at all. It's not right. Prosperous people should not buy a Medicaid or a long-term care policy either. They can fund nursing home out of what would have been a legacy. I completely agree. The middle class is the target audience for the LTC pitch. If that's where you are, you should indeed be worried about nursing costs, but you should think about other ways to cover them. Plan on using home equity to cover the nursing bill. I could not agree with that more. Plan on using home equity to cover the nursing bill. That means the mortgage should be paid off before you retire. If it isn't, you are living beyond your means. Keep working until you own the house. If the house is paid for, then if you're carted away at 87, your spouse can sell it, put the proceeds aside for expenses, and move to a smaller unit. Not pleasant, but nothing about being married to someone with Alzheimer's is pleasant. Create some more late onset income with a fixed deferred annuity. And it depends on what kind. At 65, you invest a lump sum like $100,000 in return for a life income of 21,000 a year that starts at age 80. If you don't make it that far, you lose. Okay, I'm not all that. We'll have to debate that, a different argument. It might make sense to buy several different policies with different start dates. If buying a longevity policy inside an IRA, you can use the lesser of 20. Yeah, so he's talking about QLACs. I'm just not a big fan of QLACs or deferred income annuities at all, frankly. I think either SPIA it now or put the money in the market or pay down your debt. So I'm not a big fan of that. But I do like home equity plus, and that's, I'm not going to say deferred annuities, but home equity plus something else. I 100% agree. Will they cover nursing home bills? Sure, for a few years, not forever, but those long-term care policies like that anyway. They have limits. There's no way to be protected against all of life's financial misfortunes. I agree with that. So there you go. Use equity to pay for long-term care. Couldn't agree more. All right, we'll see you.